Well, here in Spain, it's time to join Chris McCann from Blevins. Been a while, Chris. How are you?
Yeah, it has, but time seems to fly. I'm very well, thanks, Howard, and you?
I'm very well indeed. Well, we're going to be covering an investment topic this week. While deciding which assets to invest is obviously very important, so is deciding how and where to hold your investments. So, Chris, many investors buy shares and bonds and investment funds individually. But what are the benefits of having consolidated portfolios held within one arrangement?
You're right, Howard. Many people I speak to tend to initially have a relatively random collection of investments, maybe some individual shares, an ISA, some fund holdings. Now, contrary to this, holding your investments within a single structure can provide several key benefits for investors. And whilst I don't have time to cover each in detail, I'm going to mention each briefly. Firstly, it simplifies portfolio management, making it easier to track performance, to analyze asset allocation, and to monitor risk. It provides investors with access to professional management services such as advisory or discretionary management services, which are otherwise unavailable. It is typically more cost effective, reducing the administrative and management costs of holding assets in multiple countries and accounts. Many investment structures also offer lower fees for holding assets together. It is typically more tax efficient, assuming that you use an arrangement that attracts significant tax benefits in Spain. And finally, it simplifies reporting. Such arrangements will have a single comprehensive statement that shows all your investments in one place. Completing your tax returns and Modelo 720 submissions can also be much more straightforward, as you no longer need to track multiple gains and losses and other investment-related tax documents across several accounts and countries. In summary, for listeners that would prefer a streamlined, less complex approach to managing their wealth, consolidation can provide a significant advantage.
Where should the arrangements be held and managed? Should British expatriates in Spain be looking at Spain or the UK?
Well, when I first speak to people who are considering moving from the UK to Spain, it's understandable that having likely lived in the UK for most of their lives, their assets are primarily UK based. I think it's also fair to say that most start out thinking that they will likely be retaining their UK assets. I think it's also fair to say that when we begin discussing financial planning and we agree that it's not necessarily the best idea to retain UK assets, many assume that we're going to suggest that they move their assets to Spain. This is actually not the case. Whilst they are going to be resident in Spain, and whilst Blevins Franks are based in Spain, we normally recommend clients hold their investment portfolios in what we call a neutral jurisdiction. What I mean by a neutral jurisdiction is one which is neither your country of residence or your country of nationality. Some people refer to this as offshore investing, but this is not technically correct, as our preferred neutral jurisdictions are typically based in the European Union, and so there's nothing offshore about them. There are several reasons for using a neutral jurisdiction, the main ones being significant tax planning opportunities, significantly better investor protection regimes, and a wider choice of investment choices, including typically multi-currency options.
So, if not in Spain or the UK, which countries should our listeners be considering?
As a starting point, Howard, listeners shouldn't be using or considering, in our opinion, countries and territories that appear on the Spanish tax authorities list of uncooperative jurisdictions. This immediately disqualifies countries such as Guernsey, Isle of Man, and Gibraltar. As regards neutral jurisdictions to use and consider, the two most popular for British expats resident in Spain are Luxembourg and the Republic of Ireland. Both are EU-based, which can be important, and both offer significant tax advantages, full transparency, and compliance with the Spanish tax authorities.
Can you give me some examples of the tax planning that can be done if someone invests their monies outside of Spain in this way?
Yeah, look, as you can appreciate, this is it becomes more complex, but I'll give you a couple of very simple examples. Firstly, for Spanish residents using a Spanish-approved privat bancassurance based in either the Republic of Ireland or Luxembourg, can provide significant income tax and wealth tax / solidarity tax benefits. Income and gains will roll up within the policy on a gross basis without any deduction of tax. And when funds are withdrawn from the structure, you would be subject to tax in relation to the gain element of the amount withdrawn only. I'll give you a short example in terms of numbers. Let's assume that an investor were to invest 500,000 euros, and after a year, the portfolio increases by 10%. So it increases to 550,000 euros. I'm not suggesting it will, it's just easy maths. You then can withdraw whatever you want, whenever you want from the structure. So let's assume that after 1 year, you withdraw 50,000 euros. As the gain is 10%, as I've mentioned, your taxable income will be 10% of 50,000 euros, the amount you've taken out, or 5,000 euros. With tax payable at 19%, your tax payable would be 950 euros only, which based on the total withdrawal of 50,000 euros is an effective tax rate of only 1.9%. Another tax planning opportunity, specifically those who are considering returning to the UK, has arisen since the UK Labour Party's first budget in October 2024. As of April 6, 2025, you can return to the UK after, say, 20 years of living in Spain, and your investments that you retain in a neutral jurisdiction will remain fully exempt from UK inheritance tax for a period of 10 years following your return. So, if you were to die within that 10-year period of returning, the structure would potentially save your beneficiaries exactly 40% in UK death duties.
So before you leave, Chris, I understand the Javier seminar last month went very well. What seminars do you have coming up in Spain this month?
Howard, we have quite a few seminars, so I'm going to have to read this. If people, so pens ready. If you want to make a note of these dates and places, please do. But please visit our website, as I say, blevinsfranks.com, for details. You'll be able to find details of all the seminars on the website. So I'm just going to go through each one. We're having seminars in Majaca on the 23rd of April, in Los Alcázares on the 24th of April, in Mallorca on the 29th of April, in Marbella on the 29th of April, in La Vinuela on the 30th of April, and also in Tenerife and Lanzarote on the 28th and 30th of April. Now, all seminars will cover the recent UK tax and pension reforms, and we'll be discussing whether or not it's a good idea to be keeping UK assets. They'll also look at pension advice post-Brexit and cross-border estate planning.
And of course, if you want to book, you can do that on the website as well at blevinsfranks.com.
Yes, you can. You can reserve your place online, as I say, on blevinsfranks.com.